Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here, Private Lenders Podcast. Thank you for checking out the show. Real quick before we get moving here, if you haven't done so already and you're in a position where you need proper loan management software, go check out Lender, Lendr software.com. Mention this podcast for a discount. Okay, talking about cross-collateral. This is a useful tool that a lot of lenders maybe aren't aware of or don't know how to properly use it, but it can be a really good tool to do more deals, do higher loan amounts, increase your collateral and security if you know how to do it right.
How many loans do you think we have what percentage of loans do you think we have cross collateral on? 20%?
I was just going to say 20%. That would be my guess.
Yeah, I mean, we have a lot.
It happens a lot.
We have a lot, and we learned about cross collateral day one of HMB when we were working with an attorney that was structuring some deals with us. Like, hey, what other collateral did he have? And it's like second nature to us to cross collateral properties or ask for cross collateral. It's in our scripting. And I think it behooves other lenders to, be aware of it. And if you already are aware of it, make sure you're asking, make sure it's in your scripting. I remember, I don't know if there's a case about this now, but I remember years ago that we had this one borrower that always held a few rental properties free and clear. And we, in essence, would just use those for them to lever up and buy other properties. So, and I'll give you an example. What happened is, let's say they want to buy a property for $200,000, and they came to us and were like, "Hey, how much can you lend?" And they would always have several free and clear rentals, and let's just say those rentals were worth $200,000 free and clear. So what we would do is we would give them essentially 100% financing on the subject property that they're purchasing. We'd cross-collateralize the additional rental property that they had. So we'd put a lien against both of them, a first mortgage on both of them, which in essence was a $200,000 loan on a $400,000, actual cost, not ARV, value, as is value properties. It was a no-brainer. And then they'd have to bring no money to the table, or they'd have to bring closing costs to the table, or very minimum money out of pocket. If you structure it the right way, most real estate investors prefer that. And a lot of experienced investors have free and clear rentals, or they have other real estate in general because, they're actively investing and they're out on the streets all the time doing stuff. So it's interesting. We're going to walk through here in a second, kind of how we paper it and how we structure it. But in essence, it's just putting, a lien against other assets that they have, ideally a first mortgage against an investment residential property or a commercial building that they own.
Yeah, there's another good example of when we use this multiple times with one client. There's a borrower who operates in the Philadelphia suburbs, and he owns a small office building free and clear. And now he's a qualified guy. He's got cash, he's got credit. He's borrowed from us maybe 5 times, and he's a great client. Hope he comes back for more. So each time he would do a residential fix and flip, and he does pretty high-end areas, pretty good amount of construction and also high purchase prices. And we would put a lien on his office building. It's worth like $1 million or 1.5, something like that each time. And he would just pay closing costs on the subject property acquisition. And we did that 4 or 5 times easily. And that's even for a really qualified borrower who has plenty of cash. But if he can not use it and uses collateral instead, he went for that option. Not everyone will go for that. They might want lower financing costs, so they'll take a lower loan amount. But it's really the only way to do cross-collateral. It's really the only way to do 100% financing safely. Now, Jay, before you dive into some examples or some other structure-related stuff, we should probably answer this question because I know what everyone's thinking, because I know what everyone chats about in the Mastermind group and in Facebook groups and in LinkedIn and stuff like that. Is it good enough to have a second on cross-collateral, or does it need to be a first on the cross?
Yeah, it's a good question. And obviously a first is really where you want to be on all of these things. That's not to say that you can't do it against the second, but you got to recognize and understand your risks if you are doing it as a second, and how much really collateral and value you have to do it that way. Because in order to protect your interest as a second lien holder, you have to obviously safely make sure the first is taken care of and is paid off. So here's an example. Borrower owns a property worth $100,000. It's a rental property. They have a first of $50,000, and then they have $50,000 in quote unquote equity. And it's like, well, I can put a lien against that. There's $50,000 in equity. Yeah, but equity is somewhat of a fake number. You're not going to get $50,000 worth of cash value out of that. Typically, the rule of thumb is if they owe over 50% LTV, there's just no room left to do cross collateral. There's just no room left to do a second, right? Because let's say, they need like $25,000. So in essence, there's a $50,000 first, a $25,000 second. If a borrower ends up getting in default and you really need to utilize that equity as collateral, that means they're probably in default in the first mortgage as well, right? And that $50,000 might turn into $60,000 or $70,000, and it could get to a point that you're completely wiped out if you jump into that. And so there's very few instances that doing a second behind someone else's first works. We did one. There's only one I remember doing, and we did it about a year ago, and it actually paid off coincidentally last night or into today. And they had a $600,000 rental property. They owed like $40,000 on it, or like $80,000 or something, and we only needed, call it like $60,000 of like excess cash for them to get. We only wanted like $60,000 worth of value, so it potentially made sense. And a lot of the times on deals like that, it's just easier to just refinance it and turn it into two transactions. What I mean by that is you refinance the second property, you pay off the first, you get cash available for their down payment for your purchase, right? And you turn it into two transactions. It just gets a little bit of clunky. And if you are going to do a second mortgage, you got to make sure that a few things. You got to make sure that you get a copy of the note, right? So you can see what type of lender you're behind. Being behind a bank lender is obviously a lot safer than being behind a hard money lender, but you need to know the terms of what you're behind, right? Like, let's say you think you're doing a loan and they have a $50,000, balance at this point. Well, what happens if it's a hard money lender and they have a 24% default interest rate? So if the borrower stops making payments, in essence, the amount owed to the first lender grows by 2% every month. Or maybe they have a side joint venture agreement and they owe creditors something from that. So there's definitely a layer of risk to do it that way. We prefer to keep it simple. Just do it on first mortgages.
Yeah. Another answer to the second mortgage question is we've definitely done it so that we're properly collateralized on the subject property that they're buying, right? Like it'll be, 20% down plus closing costs, 65 ARV, all the normal numbers. Plus, we'll throw a second over here on another property. Of course, like a really strong borrower, you probably don't need to do that, and they probably won't allow it anyway. But in certain situations, if you can get more collateral, why not go for it, right? But if you do need to get paid back via foreclosure or something like that, you're going to be executing only on the subject property. So it's kind of acts as just like a cherry on top. I wouldn't use a second mortgage to raise your mortgage on the subject property, right?
Yeah. And like the one thing that sometimes happens that's challenging about cross collateral, or could be, is if you're in a state that has high recordation tax, because then you're paying recordation tax on both. And we are in a state where that happens, and it's limited if the properties are in the same county. But if they're in different counties, let's just say in the state of Maryland, they got to pay, in essence, we have to do two deeds of trust. So let's say they're in the same county. I can do one. They're in the same county. They have the same name. We can do one deed of trust outlining both properties and have both legal descriptions on there. So it's like parcel 1 being ABC, parcel 2 being DEF, right? And it's one transaction, it's one deed of trust, and it's one recordation tax. But if you're in separate jurisdictions, separate states in Maryland, even separate counties, or it could be in the same county, but the new properties under one entity and the rental properties under another entity, then what we have to do is two actual deeds of trust or two mortgages and record them both individually. And you get recordation tax on both. So it's a $100,000 loan, you're paying whatever it comes out to, 2% on each. And on small loan amounts, it's not that big of a deal, but on larger stuff, it is. I mean, we've had to do some. We did one in a county in Maryland, and it cost them $10,000 extra just for the recordation tax because it was a higher loan amount. just for that one recordation text in order to use that property. Now, it was worth it to them because it limited their cash out of pocket. And that's what they wanted. And that's what was important to them. But you just got to recognize this. So obviously, make sure you're scripting for this and you're asking for cross collateral. Make sure the attorney that's doing your loan docs know how to prep this. It's not all that complicated.
Yeah,
for the most part, it's either adding, the tax ID, the legal description in the current deed of trust, or if it's multiple deeds of trust. And listen, we've cross-collateralized 10 properties before, right? You have one subject property and then you have 10 cross-collateral properties. Each cross-collateral property has its owners. Then you have the guarantors. So it gets complicated, and your attorney probably is going to charge extra to do doc prep to do that. The point is, it's possible. And keep in mind, most bank commercial lenders, they're always doing this. Like if you got a regular bank loan, from a regional or national or local bank to your business, they would probably cross-collateralize your primary residence. We don't typically cross-collateralize consumer and primary residence stuff. Some states there's an argument that maybe you can. We don't. General practice, we don't. But banks do it all the time. Like it's they're always collateralizing anything that they can. So it's not all that complicated. You just need to make sure your attorney knows how to document that. And honestly, the most standard one that we do is one loan doc set with an additional deed of trust. So everything's outlined in the promissory note and the normal loan docs. And then there's the deed of trust or mortgage on the subject property, and then a separate deed of trust that they're signing, collateralizing you as a first lien position on the secondary property. And there's only good, like there's sometimes these things get a little bit complicated of like, well, what happens when they pay off one of the loans, right? And you have to think about that. But those are all good problems to have. The important part is to make sure you're properly collateralized and you're in a good position, and you typically are if you're doing that. And you get creative as the deals pay off. So like, let's say you do a loan of whatever, it's $100,000 loan. They're buying it for $100,000 and they have another property worth $100,000. And you're like, cool, let's collateralize both properties. I'll give you 100% financing. You bring closing costs to the table. And then they go and they ended up wanting to sell the rental property, and it only sells for $90,000, right? And you're owed $100,000, and they sell the rental property first before the initial purchase money loan. And then they come to you and say, hey, like I need to get a payoff, and your payoff is going to be $100,000, but then you got to do some sort of partial payoff or partial release in order to release that property. And it can be whatever you want. It can be like, hey, pay me back $30,000 and we're good, or pay me back $90,000, pay me back all the proceeds, and then in essence, you're only going to owe me $10,000 when the initial property sells. So that always turns into a negotiation. We don't really like to document how much we're allocating each property for. Just like another little tip is we don't allocate on a title insurance policy how much each one's allocated for. You're not putting, if you're doing a $100,000 loan on two properties, you're not doing a 50 and a 50. You're doing 100 on both.
People always ask that question.
Yeah.
I'm glad
100 on both.
Clarified that. Yeah, no, that question happens frequently. Like, oh, do I divide it up to each? It's like, no. It's an identical 100K lien on property A and on property B. Yeah. And yeah, I mean, that stuff, doing cross-collateral does cause partial pay. Excuse me, sorry about that. It does cause partial payoffs sometimes. And there's a couple different ways that you can handle that. We don't love doing partial paydowns. I don't think any private lenders do. It's a little inconvenient. And depending on how your software works, it could work different ways. Like one, you could actually apply it towards the principal. Like say you got a 50K pay down, reduce the principal by 50K, adjust the payment down to that new lower principal amount. That's kind of annoying. We don't love doing that. The other way is to keep it in the trust balance. And some of it depends on timing. Like maybe if it's like, okay, this month I'm selling this property, and in 1 month I'm going to sell the other one and pay off the loan in full. Okay, cool. Now we probably don't have to do a partial pay down and go through that process. We can just apply it to the trust balance. It's going to reduce the total owed. And next month when the subject property sells, it'll pay in full. That happens a lot. And so there's also, more underwriting questions that come into play when doing a partial pay down. It's like, all right, I'm only going to be left with one piece of collateral. How much do I need to require be paid down or paid off, right? Because you're only going to have one property left. You have to make sure that your exposure is where you want it. So there's kind of like a re-underwriting of collateral. Maybe something has changed during your initial underwrite, right? Like maybe the subject property was improved, and who knows, maybe even the cross-collateral property went down in value. Maybe it was freshly rehabbed when you closed, but now it's rented out. Okay, that value is lower now that it's occupied. So like it is kind of a re-underwrite when you have to release some collateral. So that's just something important to be aware of.
Yeah, and also be aware that most cross-collateral doesn't necessarily have an exit strategy. Some of them do, but most of them are free and clear rental properties, or I don't know, maybe land or whatever it is. There are other assets that they have that might not have an exit. Some of them are fix and flips that are just on the market. Like we're doing one right now that's closing this Friday where, you know, we're lending them 100%. We're not even lending them 100% financing. We would lend them 100% financing. They didn't want that much. They wanted less. But anyways, and we're cross-collateralizing a free and clear property that they have that's on the market. And so that has an exit strategy. A lot of them don't. So, and what I mean, and what's important to understand about that is you need to be positioned on your subject collateral that you're going to exit from your deal, hopefully, when that property, has some sort of liquidity event or refinance or a resale, because the the cross-collateral property is a rental property, and chances are, like, you're not selling that thing. Maybe you are, but you're not selling it. You're not refinancing it. So, the last thing you want is you do a deal and, the subject property pays you off, and this happens. And you get paid off everything except $50,000. And you're like, yeah, I'll take that. No problem. I'm just going to have a $50,000 first note on this $200,000 rental property, right? You're in a good position, 25% LTV, but you don't really have an exit strategy tied to that. So you have to kind of, strategize to make sure like the whole puzzle works. You have an exit strategy, you're properly collateralized. What happens if this pays off? What happens here? And like, don't overcomplicate it. Like, just try to wrap your brain around the concept of it. And as long as you're properly collateralized, that's good. Now, obviously, on underwriting, the borrower bringing cash to the table over equity to the table, cash is typically better. So like, we don't compare it 1-to-1, but, I'd probably rather the borrower, post a $200,000 free and clear asset than bring $50,000 to the table. I think we're probably more collateralized that way.
Yeah, the reality is that this is a tool that you can use to win deals. There are a lot of lenders out there who don't know how to do this. I don't think institutional guys do it. Maybe they do, but as I recall, they don't. So anyway, it's a tool that you can use to win more deals. If you come across one of these scenarios and you aren't totally sure how to structure it, just chime inside the Mastermind, inside hardmoneymastermind.com with us and a couple thousand other private lenders. We can definitely point you in the right direction. That's the pod for today, everybody. We appreciate you checking out the show, and we'll see you here next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.